Awesome.
All
Well,
right,
Brad,
well,
yeah, Brad, thanks for coming on today. So we're going to be talking about a 7A loan. So Brad's an expert in 7A lending. And so we're very thankful that he came on today just to spend some time teaching us about the 7A product. What is it? How does it work? Et cetera, et cetera. So Brad, thanks for joining us. And why don't you dive in and teach us?
certainly. I guess to say it's simplest and then drill down into that, the 7A loan program, I reference it as the kitchen sink loan. What I mean by that is every type of loan proceed can be wrapped into that, meaning it could be for commercial real estate, could be to buy a business, so you're buying the goodwill, could be to make an equipment purchase, could be for construction, could be for refinance of debt, working capital, inventory, buying out a partner, which would also be defined as goodwill, closing costs. All proceeds that I just shared can be incorporated into an SBA 7A loan. 7A loan has a $5 million maximum at a given time for a small business owner. Loan terms are going to be very fair for a customer. On non-real estate loans, it's typically 10 years with no prepayment penalty. With real estate, it would be a 25-year term with a very flexible 3-year prepayment penalty. When it comes to fees, the SBA charges what's called an SBA guarantee fee. That's on all loans, and it's a percentage of the loan amount. I estimate it for all loans to be approximately 2.5% of the loan amount. So if it was $1 million loan, it's just a haircut above 25,000. I think it's exactly like 26,000 and change is what it is. But to keep it simple, it's about 2.5% of the loan amount is what it is. And with an SBA 7A loan, the bank, whoever is that primary bank, they are the lender. They are the ones providing the funds to the small business owner. The SBA, or the Small Business Administration, is guaranteeing that loan 75% of the loan amount on behalf of the bank and the customer. So on that regards, banks are typically going to be a little bit more lenient in relative comparison to a conventional loan when it comes to cash flow or especially collateral in what is needed in order to make the loan conform for bank compliance, let's call it. So that, and I guess initially to start things off, is a little bit of a high-level overview about 7A.
Yeah, that's perfect. Thanks, Brad. That's great. So if we understand this correctly, then a 7A loan is nothing more than an insurance sort of product from the federal government that's given to the bank to basically then lend their own funds, that if anything ever goes south and you guys have to foreclose, how does that actually work? So like if someone foreclosed and you had to take the funds back, is it 75% of the deficiency, or how does that actually work, if you're sort of aware of that?
No, good question. So whatever that principal balance is at that given moment of time, that's the number we're referencing. So it's not going to be the original loan amount, it's the principal balance that we're focused on. The in the loan, in an SBA 7A loan, every bank is required per the SOPs, which is the standard operating procedures, to attempt to fully secure the loan dollar for dollar. So what that means is that if the business assets of the loan have a depreciated or a discounted value relative to what the asset is. So equipment is typically looked at 50% of what it is currently valued at today per the balance sheet. Commercial real estate is typically 85%. And goodwill doesn't really have a tangible value per bank. So in the world of SBA 7A, if we are not fully secured with the subject assets that we're lending on, we then look at secondary collateral to attempt to fully secure the loan. What that means is if the customer owns a residential property of any type, be it primary residence or a vacation home, and there is equity in that property after applying a 25% discount factor, then we would have to take a secondary or tertiary lien on that property. If we're still not fully secured on that loan, that's okay. We'll take out a term life insurance policy that would be assigned to us. When I say we, the client would take out that term life insurance policy to make up the gap. But the reality is that term life insurance only kicks in if the client, unfortunately and tragically, passes away. So if a loan did default, in unwinding what was originally put together, the first thing we would do is look at, can the business be sustained or operated by a spouse or somebody else, and continue to operate? Because the last thing a bank wants to do is go through the steps of unwinding. But in the addressing the question, if we had to unwind it, the first thing we would do is look at what was the collateral on the loan per the SBA authorization that was signed by the customer. So the primary assets we would obviously take back, and then we would get the maximum we could get, but that's not going to cover our loan most likely if it was a newer loan. Then we would look at the secondary collateral, which could be, again, the primary residence or a vacation property or raw land, whatever the client may own. If we're not fully secured, or I should say, if we're not reimbursed to where we're now, the loan has been paid off, at that point, then the government would reimburse us as the bank 75% of that outstanding balance. So our write-off would be 25% of what is remaining after we've taken back the assets from the customer.
Got it. Okay, that's great. And you mentioned, thanks for sharing that. So that you mentioned something that I think is important too. Like, so if it's a piece of real estate, then you're automatically, from an underwriting perspective, discounting that 15% off. So if it's $1 million purchase, it's now, in your mind, $850. There's a $150,000 deficiency. So if I understand this correctly, if they put 10% down, there's still a 5% deficiency there that you're going to try to shore up somewhere with additional collateral, correct? Does that sound right?
Correct.
All right. And if it's equipment, it's 50% discount off of the face value. And then there's just nothing for goodwill.
Correct.
Okay. And
correct.
So if they put 15% down on real estate, you're just not going to have to take anything. Is that correct?
For the most part, yes.
Okay.
The only thing that I am hesitant in answering that question is when you're factoring in the inclusion of closing costs. The closing costs obviously are going to raise the loan amount, which that is going to create a very minor, but it'll create a small gap in what would be being fully secured at dollar-for-dollar discount.
That's great. And how, like, if you did 10 loans, what would you say the frequency of getting a life insurance policy is? Is that a 85% of the time, 50% of the time? What's sort of the trigger factor for having to?
It's a higher percentage. In some instances, the customer may have equity in their property. And when I say property, I mean either their primary residence or a secondary piece of real estate that they own for investment property, what have you. Sometimes the customer is open and understanding that this lien on that property is not for the life of the loan. It is only until that future point in time when that subject commercial property that we're financing at an 85% factor for whatever that appraisal would be in the future is then equal to the principal balance of the loan at that future point in time. And when we achieve that, we can release the lien on that property. So in today's times, yes, it is more common because properties have appreciated. Some small business owners have accumulated an investment property of one form or another to where we would look at that secondary collateral for being pledged to the loan. Now, on the other side, there's nothing stopping a client before we run personal credit from taking out a home equity line of credit against that property to where we in turn would not need to take a secondary lien on that property because they are the equity that would be visible is less than the requirement for SBA compliance. So then the term life insurance gap would come into play And that actually, to get term life today for an SBA loan is pretty easy as long as the client is in decent health. And it's pretty reasonable from the premium cost as well.
That's great. And so why is it, if I'm a borrower, why do I get an SBA loan? What is it that, why would I get an SBA loan versus, going and just getting a conventional loan from a bank? What would be the reasons why I would go get a 7(a) loan?
Great. There's a few reasons. Number one, right out of the gate would be down payment.
Yeah.
So typically you get a conventional loan today, and that's again, leading into what would be the second would be qualifying. But the first thing would be down payment. Typically and give you a standard example for what down payment is on an SBA loan, regardless if it's to just buy a building or if you're buying a business or buying out a partner of the business that you own, it's typically 10% down, typically. Some banks like ours, we will do 100% financing on that commercial property to where the client doesn't really have any monetary outlay when it's all said and done. Now, if they're doing construction, the expectation from the architect and the engineers they're going to want to get paid as they're doing their work. We in turn would reimburse them back at the closing table to where, again, the net out of pocket would technically be zero for that small business owner taking out that SBA loan. So that would be the first reason. That's a very big reason. And especially in times like this, where COVID has shown us a lot about preserving liquidity and some have actually depleted their liquidity to where they may see a great business opportunity to buy a business or buy a property for their business, but they don't have the traditional down payment that a conventional loan would require. Secondly is the term. The term on a real estate loan in SBA is 25 years. So that's going to achieve a lower monthly payment, obviously, versus if it was a 20-year conventional or a 15. And then also on a business loan, it's going to be a 10-year term versus what in conventional world could be a 7-year on average. And some do go 10. But even on equipment, it could be a 5-year as well. So achieving a lower monthly payment per cash flow benefit is another strong reason for going SBA. And I'd probably say even lastly, to go SBA, the cash flow requirements from a bank, when you have that 75% guarantee from the government, banks in general are willing to stretch their debt service coverage requirements a little bit more than when a bank is doing a conventional loan, but they're going to want to see on average, 2 years of historical debt service coverage to show that the client can support that payment. So those would be the three big drivers, in my opinion, for why a small business owner would want to go with an SBA loan.
That's great. Thanks, Brad. And then the other thing is the SBA loan available for investment, or is it just owner occupied?
Part of the premise of an SBA loan is for the small business owner operator. So to give an example, some of my clients, they want to buy a building that they're only going to use 60% on, let's say for this example, of the available square footage. And then they want to sublease out the other 40% for some investment income opportunities. That's absolutely okay. The threshold in SBA is you have to occupy at least 51% of the square footage, and common area does count. So if there's hallways and closets, reception area, that does count towards their 51%. But it has to be, again, more than 50% occupied by the small business that the loan is being provided to. Anything less than that, unfortunately, would not be eligible for the SBA loan.
What about if it's new construction? Does that make a difference?
If it's new construction, then the technical rule is that initially you have to occupy 60% of the space. And then within, I believe it's 3 years, you have to occupy 80% of that space. However, banks view the post follow-up differently. So some banks won't revisit in their back office 3 years down the road. Did the client actually take over that space? Is there another tenant? But the way that the SBA's standard operating procedures read, in a ground up, you have to occupy at least 60% initially, and then technically 30 or 80% 3 years thereafter.
Right. And you talked about a $5 million cap. I just want to elaborate on that a little bit more. So the max one borrower, doesn't really matter if they have 10 entities, but one individual human flesh borrower wants to borrow, they can't get more than $5 million worth of loan. Is it loan proceeds or the guarantee, or how does that work?
So in an SBA 7A world, the maximum that you can obtain at a given moment is 5 million. Now, sometimes, and I've seen this, it's more common in franchise space, but it can be even in other industries as well. If a small business owner has multiple millions of dollars in SBA loans at this time, and now they're looking to do an additional project that would put them over the $5 million cap, they could potentially refinance some of their existing SBA debt, which in turn would free up the SBA dollars. So they'd refinance conventionally, free up the SBA dollars for that new project, to where then again, at that moment, they would still be underneath the $5 million cap.
Got it. That's perfect. And then my other question is, let's talk about fees too. So so it's going to cost them, call it 2.5% of the total loan. Does that sound correct? Okay.
Yes. Yeah, that's the way I was explaining it, correct.
Agent. Okay. And then is there additional fees too, like a packaging, because there's typically what, like packaging fee, which is $2,500 usually, typically, give or take.
Yeah, so typically, most of when you compare conventional closing costs to SBA, when you're looking at a settlement statement,
Yeah.
there's a lot of overlap. Your third-party reports, your title work, your searches, all of those are going to be the same. Where things are maybe a little bit different, and some banks actually will be open to negotiation on that packaging fee that you mentioned.
Okay.
So some banks it's 2,500. Our bank is 1,900 and change. But I can share that if a client, if that's something that is a concern to the client, that it could be negotiated for that piece. Some banks use outside legal counsel for their drafting of documents, and some do it in-house. So that could be an additional cost, but that also could be conventional versus SBA as well.
Okay, that's great. And in terms of, a lot of times there's sometimes a stigma out in the marketplace that the SBA is just a pain in the butt and it's so hard to get those loans. How do you typically respond to that? And maybe it's so how would you respond to that, with respect to, I could just go get a conventional loan versus just an SBA loan?
Well, as we know, Dave, it's perception versus reality, right? Yeah. The perception is that SBA is a 3-letter acronym for, aggravation, frustration, paperwork and fees and everything else. The reality is more clients, unfortunately, don't qualify conventionally and then have to go the SBA route, but also they qualify SBA, but they don't have the organization, the patience, the listening skills. And I think part of it is on the client, but the other part of it is on the SBA loan officer that is hand-holding and hopefully shepherding that client from point A to point Z. I can share in my 21 years of doing this, I learned something from every customer that I work with. And I try to take great pride in creating best practices to manage expectations and set expectations and preparations for our clients where we minimize or hopefully achieve no surprises through the process. Clients, as I share, that are good listeners and follow instruction, my ultimate goal and hope for them is when we get to the end is that I prepare them for a a process, but a process that can be achieved. Versus if they're not being handheld, if they're not receiving proper expectations, then yes, it absolutely can be frustrating. It can be aggravating. And in some instances, the client just throws their hands up in the air and says, I give up, I'm done. But it's a two-way street. It's the loan officer doing their part. And then it's also the client being understanding to knowing it's a process to get a loan.
That's good. And then does it make a difference in your world whether you're a preferred lender or you're a sort of, what is it, PLP versus CLP, et cetera, et cetera?
Oh, absolutely. Absolutely. So a preferred lender, or otherwise known as the acronym PLP, means the bank has got the approval from the SBA themselves to do all of the approving of the loan and processing of the loan without having to go to Big Brother, if you call it, to get their stamp of approval. Yeah. It's a world of difference when working with a bank that has that status, and most do, but some do not. Yeah. And if the bank does not, or the lending institution does not have that status, and they're a general lender, and if they're a general lender, what happens is the bank will underwrite the loan themselves to get an initial comfort level themselves, but then they take the entire loan file and then they have to submit it to the SBA for their full formal underwriting. And their process is a lot more tedious and monotonous in their due diligence versus the PLP lender, which has enough experience, has done these loans. They understand cash flow and debt service coverage, understand collateral. We know what happens as a PLP lender. The SBA will audit random loans over the course of the year to determine, are you still honoring the SBA's guidelines? And as long as that bank or financing institution is keeping good controls of their loan files, they'll get their license renewed. And that's typically the case. But if you're a small business owner and you're working with your financing institution, they're a general lender, that's concerning to me as a loan officer. So no matter who that institution is, because more than likely that process is going to take double to possibly triple the time with a lot more aggravation.
That's good. And what sort of, form, maybe talk a little bit about forms and then process a little bit. What kinds of forms is the client going to have to give you? And then what's the general process that they should be expecting and walking through with the SBA?
Certainly. So underwriting for pretty much all banks is going to consist of, to get the loan to underwriting, the past 3-year personal and business tax returns, current financials for the business and any affiliates that they control, the bank's loan application. If they're buying a commercial building or if they're buying a business, you're going to want to get a copy of the executed either letter of intent or purchase contract. If they're buying a new building, bank's going to want to see their existing lease that they're in to see what the remaining term and if there's any other hooks in that lease. And that's pretty much the standards of what a bank needs to obtain in order to underwrite a loan. Underwriting typically takes for most banks between 2 to 3 weeks on average. And during that time period, the underwriter will schedule a call with the client that could last between 30 minutes to an hour. Most of those questions the underwriter is going to ask is just confirming facts that they've already received. And some is just expanding upon what was already provided to make sure they have a full understanding of the client and their business. Some banks use loan committee for decision. The underwriters have the authority to approve the loans themselves. But once a loan is decisioned, it should equate to what's called the commitment letter. That's typically about an 8 to 10 page document that spells out all the terms and conditions with the loan on the approval. So in addition to third-party report requirements, if there's anything pertaining to getting current interim financials, lease terminations, any type of, if the client had any type of felony or misdemeanor, getting that resolved. So those are some examples of things that could be conditions in the loan. But as I shared, typically about 2 to 3 weeks to underwrite and get the loan decision with the approval. Again, at that point, then the loan can transition from the underwriter's desk and then be assigned to a loan closer. Closing on a non-construction related loan should take no more than, I would probably say, 6 to 7 weeks thereafter. So in totality, from day one of submitting the loan to underwriting to day of close, should be anywhere between 7 to 9 weeks for a non-construction related loan. So that could be either buying a business or buying a building that's turnkey. If you have construction incorporated in the loan, there's going to be a little bit more time required because banks are typically going to want to see full copies of the architect plans, a fixed price construction contract from the contractor, and then some banks will want to have confirmation that the city has blessed those plans where they know that the permit is available for pickup. And some banks may be comfortable with knowing that, again, the permit is pending, but plans have been submitted and they're okay closing at that point. So in that instance, again, depending on the complexity of construction, a TI project could possibly take, let's say, between 10 to 12 weeks. And then if it was a ground up complete project, depending on the complexity, it could take multiple months from day one of submitting the loan to underwriting to day of close, just knowing that there's going to probably be a lot more involved when you're dealing with the municipality.
That's great. And like with respect to, like, if somebody has ever defaulted on any federal debt, does that become an issue with the SBA?
Well, it does. So if one were to ever have failed or defaulted on an SBA loan before, they are basically unable to get an SBA loan ever again. It is unfortunate, and I've had it come across a couple times. One time the client was upfront about it, and the other time they were not. This is part of, call it the bank's behind the scenes due diligence that they do when it comes to background checks and making sure that the client is in good standing.
That's terrific. Is there anything else that you think that would be helpful for us to know that we haven't already covered, Brad, at all on the 7A loan?
I would say this, right now is interesting times. And this is not, it's an incentive, but it's not an incentive that is because of a good thing. It's an incentive for stimulus to try and help the economy. But with COVID, the government rolled out what was called the CARES Act. And in the CARES Act, there was a lot of, call it stimulus to try and promote new opportunities for small business owners, and also to try and help, keep them afloat during these times. The current stimulus that's incorporated in the CARES Act allows for the client that if they close a new loan by September 25th, which is coming up, of course, the next 6, or the first 6, I should say, principal and interest payments are to be paid by the government, which in my 21 years of doing this has never happened before. But obviously we've never dealt with a pandemic in our lives before either. So again, that is something that there's rumors of extension of that, but I will also share, I don't know anything more than just the fact that there has been a lot of new opportunities created because of this upside. So hopefully, again, there's something additional. In my past, there were times, again, when we were in a recession, if we recall, going back to the latter part of the 2000s, there was a 90% guarantee rolled out to banks from the government versus a 75% guarantee. So by helping banks stimulate them to know that instead of being 25% exposed or only 10% exposed, that incentivized banks to be a little bit more aggressive in putting funds out the door, because as we know and recall during the recession times, banks were just trying to hold on to their own access to capital that they had. So with an SBA program, there's always the potentials for additional stimulus either to the bank or the small business owner to help stimulate opportunities, which with the conventional program that doesn't really exist. For example, I know right now, conventionally, what typically is a 80% loan to value threshold for refinancing a commercial property. I just learned today one institution has actually lowered theirs to 65, which was surprising to me, but that was just their policy. So SBA, without question, is more paperwork, but I think going back to what I shared, managing expectations, setting realistic expectations, having the right person there to handhold the client makes it achievable for the small business owner. But then also knowing that, again, most times an SBA loan is not forever. The average prepayment speed on an SBA loan for a small business owner is a little over 7 years. So what that means is that if the client takes out a loan to buy a building, and let's say they incorporated construction and they came in with 10% or less down, well, kudos to them for keeping their liquidity and getting a 25-year term at a good interest rate. But maybe in a few years from now, 5 years, 6 years, 7 years, they have an opportunity to refinance conventionally, get a slightly better rate, not have a secondary piece of collateral pledged, have a longer term fixed rate for the life of the loan for whatever that conventional loan might be. Then the SBA's loan, again, only has on a 7A a 3-year prepay. So after month 36, there's no longer any handcuffs to the loan. So then that small business owner, by all means, can look to refinance and put themselves in possibly a better loan, which again means the SBA loan was, I use the term training wheels, to allow for them to then ride the bike without having any assistance of any type.
It's terrific. Well, Brad, we really appreciate you taking the time. Obviously, you're a great partner, and we're thankful for your education and your time today. So appreciate that.
No, thank you. Yeah, no, Dan, very nice to meet you. And Dave, it's always a pleasure. And look forward to any future opportunities we can partner on together.
We will be definitely calling out to you, my friend.
Thank you.
Okay, excellent, guys. Take care. See you later.
Take care.